Are you looking for a friend in financial services? Somewhere you can come to learn what you need to know to build that better path to prosperity? Well, you've come to the right place. The Master of Money program is designed and built for you, the person who is trying to build wealth for themselves and their families. Join us tonight as we travel down the path talking about currency wars on the Master of Money.
This Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to individuals. Our special guest is Mr. Jeff Garbaz, Principal of Quantitative Partners and Superstock Investor. This Master of Money program was produced Tuesday, May 5th, 2015.
Hello again, everyone, and welcome back to the Master of Money program. I'm Steve Beeman, your host, and what a pleasure it is to be with you each and every week to share my 30 years of experience with you here on the Master of Money program. Tonight, we're going to be talking about something that's made billions of dollars for people like George Soros. In fact, enough money that some people refer to Mr. Soros as the Dark Lord of the Sith, using that euphemism from the Star Wars trilogy. Well, we don't think of George quite that way, but we're going to show you tonight how currency trading has been used by so many to make a great deal of money, but by others, it's simply something that costs them money. Second half of the program, we're going to talk about that with our special guest, Jeff Garbaz, and he's going to share thoughts with you from the recent book, Currency Wars. So stick around for that for certain. Last week on the program, I spoke with you about a new innovation from Wall Street, something referred to as folio investing. I spoke to you about how folios can be used to build custom portfolios for you and how there were characteristics of these things that made them really interesting as a possible add-on to your portfolio itself. Talked about diversification, very low cost to these things, liquidity, and customization, as well as some other things. And I also mentioned 3 specific providers to you who sell folios as investments, one of whom, Formula Folios, is run by my good friend Jason Wenk, who I do hope to have on the program for us one time or another. So we'll keep you posted when Jason gets on the program. But I hope you found it interesting. And as always, if you have questions on that program or any other program, write me at questions@safefinancial.org, and I'll make sure to get an answer to you right away. In our questions section, by the way, I had a person write me last week, and they asked me why the society hadn't been on what are called TED Talks. Apparently, they were watching a TED Talk talking about neurobiology, and the commentator said, neurobiology, or referring to that, this is something they don't teach in schools. Well, that made this person think about my often used phrase that they don't teach financial education in schools, and so they wrote me and asked me why I haven't been on TED Talks. Well, here's the situation. For those of you who don't know what a TED Talk is, this is a forum in which what are called thought leaders are given a videotaped forum to speak to business leaders, government leaders, social leaders, education leaders from around the world. It's a wonderful venue to share thoughts, and we have been presented to them as a possibility to talk to the TED people about financial education. It certainly is not something adequately done in the United States, and in fact, it's not done in most of the world. And as the world grows to be developed, especially in the lower and middle parts of the world in Africa and Asia, financial and economic education will be absolutely critical. So we would welcome the people at TED Talks to bring us on, but I want to thank that listener for bringing that up, and I want to thank that person for supporting us in our endeavor to get on TED Talks. Moving into the geopolitical world, I owe Prime Minister Abe an apology. Last week on the program, I mentioned to you that the Japanese Prime Minister Shinzo Abe was in town meeting with our president. Well, last week I referred to him as Prime Minister Shinzo Abe, A-B-E. Well, his name is pronounced Abe, and for that I owe the Prime Minister an apology. But he's in town talking about trying to boost Japan that has had for 20 years an economic malaise. They can't seem to jumpstart their economy. It used to be called the lost decade. Well, now it's the lost multiple decades. They just can't get off the dime. In response to that, Prime Minister Abe is looking at several things, including getting the economy going, getting the social side going, because they want to create some consumerism in Japan. And the third triangle, or third part of that triangle he wants to do, is to rebuild the effectiveness of the Japanese military. Now, as many of you who study history know, after World War II, the Japanese were specifically prohibited from building a military by their own constitution. Well, in recent years, as the geopolitical circumstance in Asia has changed, with China developing and the United States seemingly backing down on some of its military development, the Japanese have said for their economy and for their own security, they need to re-engage a military. So they're going to begin spending money in that segment of the economy, which in the short term, military spending is very stimulative. In the long run, it detracts from the economy, but in the short run, Japan is hoping that it kickstarts them out of this really malaise they've had for about 20 years now. Let's hope, by the way, that malaise Japan has had doesn't come home to the United States. Some of the setups are pretty much the same. We obviously keep an eye on that. We'll talk about this first quarter's performance in a moment, but this Japanese situation is something we really hope doesn't replicate throughout the Western world. I want to talk with you about Venezuela. As you know from watching the Master of Money program, Venezuela is this little bastion of socialism in South America. They've claimed since the days of their dear leader, Hugo Chavez, that socialism is the better solution for the Venezuelan people. It sounds good. Everybody gets everything. But what's happened in Venezuela is they have two problems. They have big shortages of consumer goods, including food, and they have massive inflation as the governments use their control over the purse to just spend the money, which has devalued the Venezuelan dollar. Well, this last week, in response to these problems, the government of Venezuela said, well, since we have a shortage of food, let's nationalize food distribution. So they are implementing a program to nationalize food distribution, which will cause the shortages to get all the worse. On the other side, because their inflation rate's running at 68% a year, they told all the government workers they were going to get an immediate 30% raise. Well, there's two problems. It sounds good, a 30% raise, but it's against the almost 70% inflation rate. And secondly, because they're now spending more money, that inflation rate's going to go up even more. You'd think the Venezuelan people at some point would get a little tired of their socialist utopia and maybe move a little more toward market forces, as has happened in Russia, in China, and other formerly socialist parts of the world. Finally, in the economic side, next week on May 7th, there are English elections. And while we normally don't pay a great deal of attention to elections taking place in Europe, this one you might want to watch. And certainly stay tuned to next week's Master of Money to talk about it. England is having a major national election, and there are three things that I think are important about the election. Number one, this will get into Scottish independence once again. You may recall from last fall in the Master of Money, we talked to you about the Scottish people very aggressively pursuing independence from Great Britain. Well, this election could reopen that can of worms, and I think it'll be interesting to see there how well Great Britain stays together. Secondly, this election will openly call into question England's participation in the European Union. We've talked here on the program about Greece and the different problems in the European Union right now. A lot of people in England are wondering why they're part of it. They don't like being part of this forced European currency. They want to go back to an autonomous currency. And this election could have a great deal to do with where England stands on the EU, on the euro, and that translates into NATO again. So you've got this continued turmoil in the European community, and we're going to be anxious to see how it turns out. So make sure you stay tuned for next week's Master of Money, and we're going to talk about the English elections. Moving into the economic side, we saw last week a rally in the euro, mostly based on the weakness in the U.S. economy the first quarter. As I mentioned to you, the Fed governors were meeting last week, and as they came out with the final first quarter numbers, the U.S. economy grew at a whopping 0.2%. Not exactly stellar performance. Now, that's not a surprise to the masters of money. We've talked about this at great length. But as it officially hit the wires, the European currency actually strengthened against the dollar. It's now trading, what's the number? I think about $1.11. So it's up a little bit based on that poor first quarter performance. But with England now in the turmoil going on in Europe, I'm not sure you're going to see the European currency all that strong in the future. Once again, that ties in beautifully to tonight's program. Second half of the program, we're going to see how you might be able to make money on that changing value of the euro to the dollar. As I said, the economic growth in the first quarter was a dismal 0.2%. We've talked about it. We had real strong growth in the second, third, and early fourth quarter. But as the fourth quarter came to an end, sales just seemed to stop. Well, in fact, when the numbers came out, the economy did effectively grind to a halt in the first quarter. Yes, there are some weather things. There are some different effects that drive it. But I think there's a lot of question why it went down so much. Is it fear over uncertainty in Europe? Probably. Is it fear over uncertainty in the implementation of the healthcare plan? Probably. Is it fear over the seeming stagnant economy we have in terms of middle-class jobs? Probably. There's a lot playing into it. As we come into the second quarter, we're going to monitor the economic numbers very, very carefully and see if we can't dissect exactly what caused the first quarter and use that as a forecast of what might happen in the second and third. We do know that based on the Federal Reserve's meetings last week and their analysis of the situation, they believe that that dismal growth will lead to no inflation. As a result, they've postponed raising rates certainly from the second to the third quarter. And although we're not afraid of that, our expert Doug Roberts told us not to be afraid of it. But we want to make sure that we keep an eye on what the Fed is doing. You can see how the market reacted last week to it. We'll talk about that in a second. But the markets are very sensitive to these interest rates. So as the Fed now postpones another quarter, you see positive moves around the world in the markets because that means inflation is low and interest rates are going to stay low. One of the other things I wanted to mention as you look to last week, interestingly, gold came down a little bit more. We've seen gold in kind of a slump. A couple of years ago, it hit $1,400 or more an ounce. People were running to gold because the U.S. dollar was going to collapse. We were going to have all this inflation. Well, that hasn't happened. As a result, gold has settled in about $1,100 an ounce. I've spoken with you in the past that gold is a great hedge long-term against inflation. But you don't typically make money on it. That is, unless you trade it. Well, we want to be careful that we don't get overly bought into the fear mongers, the perma-bears, who will tell you that you should buy gold and run for the hills. I caution you about that frequently because I've seen it happen where people have liquidated all their other investments. They've bought gold, and while we think gold has a part of your portfolio, certainly not 80% of it. So we don't want you to get caught in that trap. And last week, gold again, trading at about $100 or $1,100 an ounce, showed that it's not going to respond until inflation comes back. We don't have any reason to think that's the case, at least in the near term. In the financial markets, I thought it was most interesting to see Freddie Mac and Fannie Mae, those two mega organizations from the government, go through their own levels of stress testing. You may have heard me speak in prior Masters of Money about U.S. banks going through stress testing just to make sure that they have the capital base that if we have another market decline or an economic slowdown, they don't go to the FDIC for money. Well, Fannie Mae and Freddie Mac went through this stress testing process. Yep, a couple of things that I think are predictable happened. First, they passed. Well, these are quasi-government organizations still. Of course they're going to pass. But I thought it was interesting in the footnotes. When you looked at the footnotes to these reports, it commented that if things did get bad, you could expect between $68 and $137 billion of taxpayer money used to bail them out. Well, so much for being financially solvent. What they're saying is, yeah, they're going to do fine unless the economy turns south, at which case the taxpayer's on the hook for another $100 billion. Well, they didn't treat the banks that way. When the banks didn't pass or didn't pass highly enough, they made them make private sector changes to their balance sheets. They cut dividends. They boosted reserves. With Fannie and Freddie, they just say, well, the taxpayer's on the hook. I'm not real happy about that, nor should you be. But it's something that we want to make sure when we go to the polls, we show our politicians just how upset we are that they keep bailing these people out with our money. When we come back tonight, we are going to be talking about this interdependence of the global economy and the currencies that take place. A few weeks ago, I had a program, and I mentioned to you, or I shouldn't say I mentioned, but we looked into the real value of money, and we talked about how all money is at this point in time a fiat currency. There's no real underlying value to any of it. Well, as a result of that, especially when the U.S. came off the gold standard in 1972, all of these currencies float against one another. Well, there are a lot of things to look for to determine which currencies are going to win and which currencies are going to lose. And we're going to look into those when we come back, as I said, with our guest, Jeff Garbaz, as well. So stay around, and we'll be right back after this short message.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the program. You know, it is genuinely my pleasure to sit with you each week and try to bring my experience to you through the Master Money program. I've spent 30 years of my life doing this, so I think I've accumulated a few nuggets of information, and I'm glad that I get to share those with you. Now, sometimes as we go through the program, sometimes I cover some pretty basic things. I mean, the fact is, you build a house from the foundation up, not the other way around. So we do teach things like how to get out of debt, how to balance a checkbook if we have to, what's a bank, an insurance company, all that. But there are also times when we try to put some dressing on the windows. We try to give you the high-level information that if you want to use it personally, wonderful, but at least you'll know about it, so when you talk to your advisor, you won't be bamboozled by someone who uses big words you don't understand. Well, tonight's one of those high-level programs. We're talking about currency trading. This is something that over the years has gotten very popular. In the 1970s, the U.S., you've heard my history lesson on this before, but the U.S. came off the gold standard under Richard Nixon. When that happened, we had a couple of dynamics take place. First, there was no longer a fixed currency in the world. All currencies floated against each other. Secondly, we had a negotiation with the OPEC nations that they would be based on the dollar, so the U.S. dollar became the de facto reserve currency for global trading and transition. Well, over time, what's happened, of course, is that the economy of the world has changed. 1972-73, the United States was far and away the dominant economy in the world, really no challenge to it. Well, today, as we sit here in 2015, the Chinese actually have a bigger economy than we do. We've talked about that. Now, we're far more productive than they are, but theirs is bigger just by virtue of the size of their population. In addition to that, we've got globalization that's taken place so rapidly and so completely, national boundaries are rapidly dying off. The fact of the matter is, if you actively use a computer system, you can buy product from around the world as easily as you can from your neighborhood store. Well, this is changing the dynamics of money, and currency trading is evolving around that. It's a very lucrative part of trading because there's a lot of volatility, and volatility is what leads to trading profits. But as there's volatility in the short term, there are also fundamentals that you need to be aware of in the long run. A currency, after all, or buying into a currency, is no different than buying into a company stock. There are fundamentals you need to look at to determine the worth of any currency. I mean, I've listed just a few of them. I mean, we think about, first of all, how large is the country's economy? You don't necessarily want a currency of a very tiny economy. It may not be as liquid, or it may not have the scalability that one of the larger economies has. You want to look how stable the economy is. Is the economy growing? Is it low inflation, high inflation? We talked about Venezuela. Would you like to buy the Venezuelan currency with a 68% devaluation going on every year? I don't think so. But the U.S. dollar, we have virtually no inflation right now. Now, a lot of people will dispute that, but the reality is we don't. And as a result, the U.S. dollar is very strong. If you look at other things, political stability, yes, we in the United States have our problems, we have our battles, but when push comes to shove, we are just about the most politically stable country in the world. Now, we aren't the best at everything, and I'm not going to be so pro-American that I'm blind to the areas that we're weak. I mean, clearly education, we're failing or falling behind. When it comes to debt, we're actually growing into a real problem there. But generally speaking, the United States has a very stable political climate, a very strong economy, a very robust, market-driven, diverse economy, and all of those things help. Some economies, and specifically you look at Russia, they may have good, economic growth, but they're a single sector economy. Their energy sector is all they've got. If they lose oil as a commodity, or we've seen prices come down from $100 and something a barrel down to where they are now at 56, 57, that really crushes an oil-based economy, which is why Russia's in so much trouble. So as you're looking at currencies, you're looking at the size of the economy, the diversification of the economy, the stability of the economy. You're looking at population growth, because economies need population growth in order to grow. You need to look at these demographics and these economic demographics just as you would a company's information. It's different information, but it's very similar in determining the value of an underlying currency. We know, for example, that the U.S. dollar, the European Union money, you take those two things. The European Union and the United States are virtually the same size economies. In fact, I think they might be just a little bit bigger. We have about the same size populations. We're both pretty stable, and that's why there's relative stability between the euro and the dollar. But as Europe goes through these transitions with Greece, with England in their elections next week, with Russia pushing in from the east, that will cause instability in the euro, which will cause the dollar to raise against it. I mean, the fact of the matter is, around the world, when people are scared, they still come home to the dollar. So there are times the dollar is a better place to trade than others. Keep in mind, the markets are relatively efficient. So just because you think to yourself, gee, I like the dollar, I'm going to be in that, it doesn't mean it's going to go up versus other currencies. These things trade very dynamically around each other. I mean, there are other things to look for. Look at, for example, what are the national reserves? Every country has hard currency reserves against its economy. The United States, contrary to all of the negative talk you hear, the United States is the world's largest holder of gold, for example. The second to us is the International Monetary Fund, and that fluctuates back and forth a little bit. But the fact is, the United States has massive reserves against its money, more so than other countries, which is why the dollar is still holding its value vis-a-vis other currencies. So these are fundamentals that we look at. And just as any stock in a company has fundamentals, Well, the fact of the matter is currencies do too. And in the long run, those fundamentals play out in the value of that asset. Okay. With that said, though, there is a lot more short-term trading opportunity in currencies. And when you trade, you're looking at the dynamics that get into the technicals, the volumes, all these other things we talk about in trading. And for that, we're going to go right now to a segment with Jeff Garbaz.
Well, Jeff, welcome once again to the Master of Money program. It's awfully nice to have you here to teach our money masters. Today, as you know, we're talking about currencies and currency wars, that thing that has George Soros called the Lord Dark Emperor of the whatever it was in Star Wars, Darth Vader's dad.
The Sith.
There you go, the Sith. I'm not that big a Star Wars guy, but I appreciate your coming on to teach us what you know and help these people know how to make money and how to avoid the real pitfalls in currencies.
Yeah, I mean, currencies are a very tricky thing, and they've had an influence, especially as we came out of the 07-08 period. But looking back historically, they've had a much bigger influence, even going back into the to the 1800s for the United States. So it's something that we've had to exist as a country, and other countries have had to exist with us as well.
Well, Jeff, let me ask you, to what extent do you think currency trading became a bigger thing after Nixon took us off the gold standard, which effectively free-floated the U.S. currency against everybody else?
Yeah, that was actually the what I call the second currency war that existed between 1967 and 1987, where he put in price controls, as you mentioned, and he basically said no dollar for gold anymore, and it's dollar against everything else, and then everyone floated against the dollar, and that's the environment that we've been in ever since.
Well, now, using that, lots and lots of folks have made money doing this, again, George Soros being the kingpin of that. But to what extent, Jeff, do you think currency trading is viable for normal people who want to make money in the markets?
I don't.
I love honesty. Can you extrapolate on why you say that?
Yeah, because everyone was sold this bill of goods that basically they had an ability to trade currencies. They didn't move around very much, and that all came to an end with the revaluation of the Swiss franc. The Swiss got pissed, and overnight it went up a lot, and it basically took out several $100 million of people's money and took down a brokerage firm. So kind of proves that if you have politicians having to act because their currency is going to such a level that you're at risk any morning you get up, that what has been the normal is now not the normal.
So when you're referring to the Swiss situation, that was actually in the recent past, where because of effects of the euro, the Swiss went out and did some major steps to strengthen their own currency.
Yeah, if we look at the best example is to look at FXF, which trades. I'm just pulling it up here on my computer, so I'm sorry I'm kind of looking away for a second. But it's a great thing to take a look at, and we can look at exactly. And I want to give some people kind of a comparison. Yeah, so it happened in January. Literally, you came in one morning, it was trading just right below 96, and by the end of the day, it had gone all the way above 112. The next day, it went to 115.
Those are some big moves.
So let's say you had been short coming in that morning. It never moved at all. The average range of it was a very small movement every day, and all of a sudden it made this hellacious move. You were basically screwed.
Yeah. Now, let me ask you this. As we talk about especially Europe right now, the euro seems to be holding its own against the dollar, but we've got turmoil in Greece. We have British elections next week, which could spell the end of Great Britain's participation in the euro. What's your sense on the euro versus the dollar?
Yeah, I remember Great Britain, too. It basically participates in the euro, but it does not use the euro currency. They're still on the British pound, so they still are away. They're part of the European Union, but they're not really part of it.
Right.
It's kind of a tricky thing, and the really tricky thing here is with Greece as well, which basically just doesn't have any money, and how that's going to play out. Whether they're going to give them more money or we're going to go to something new, it kind of remains to be seen. I mean, effectively, if you look at where we are right now, there's really potentially four possible scenarios of what I call the third currency war. You know, the second currency war, which I alluded to earlier, was from 67 to 87, The first currency war was 1921 through 1936, direct result of World War I, then played into Germany blowing up to the Weimar Republic, hyperinflation, aggression by the Japanese, moving into Asia over the same devaluation of currencies, the Germans doing the same thing against the Europeans, and then we moved into World War II, and in the same time, we had a depression that came with the crash of the stock market in 1929, and then I'm trying to think about what year it was when I think it was 33, Executive Order 6102, where Roosevelt took "You're in my gold" as well. Yeah. So there have been some crazy things that have happened in the prior currency wars. I'm a big fan of paying attention to. As a matter of fact, I've got a book right here, James Rickards' Currency Wars, which is a great read. I suggest everyone go read it. He's a Johns Hopkins educated economist, very smart guy, definitely knows what he's talking about. He sees four scenarios where we are right now. The first is that the dollar and a couple other currencies become the fiat currencies of the world, as opposed to just the dollar being. Right now, the dollar is the fiat currency.
Right.
It makes sense that China is going to try and push its way into being part of that whole situation as well. Maybe the euro gets into it. The guys who are going to be screwed are the smaller guys. That's scenario number one. Scenario number two is kind of a really scary scenario. It's called SDR, which is special drawing rights, which basically means that the IMF is in complete control of everything, which is kind of crazy because the U.S. set up both the IMF and the World Bank, and an implicit rule in the creation of that was that we would be in charge of the World Bank and a European would be in charge of the IMF.
Right.
Now actually have a very capable IMF leader in Christine Lagarde. She's pretty awesome. She's smart. She knows what she's doing. But it's just a difficult situation.
Jeff, I've written articles about those special drawing rights because, to your point, I think that is a potential path for the future of currencies. As national boundaries break down more and more with technology, I don't think China is going to get support to become the reserve currency. So you do have these two paths. You have the macro baskets of the euro, the dollar, and the yuan, or you have the special drawing rights. And I wouldn't want to place bets on where that will go.
And then we've got a third scenario, which is we go back to the gold standard. Everything is pegged against the gold worldwide. So, I mean, that's kind of been happening a bit by bit, and there's been some really key things that have gone. After a kind of interesting thing is after World War II, a lot of the gold that existed in Europe now resides in the basement of the New York Federal Reserve.
Right.
Bit by bit, the Germans have been asking for the gold back. Obviously, you can't bring tons and tons of gold back very easily. It's a difficult and it's a lumbering process. But they're working their way to doing that. So potentially, if that's the case, and we don't do a dollar basket, we don't do SDR, gold becomes the standard, and then the price of gold can really rocket over time.
All right, so you're a betting man. If you're looking at our money masters right now and you're telling them where they might want to play in this space, are you looking at gold as the play?
Look, I think gold should always be a piece of someone's portfolio. I think there's nothing wrong with having 5% in gold. I mean, look, if you get a 25% pullback in the price of gold, that's because the economy is typically probably doing really well, and then your stocks are going to be fine. So if you pull 25% back off of 5%, it's a 1.25% loss. It doesn't impact the portfolio. It's a decent hedge. I would probably use GLD or IAU as opposed to playing the miners or that other stuff. I mean, look, the bottom line is right now we're in a deflationary environment. Deflation is the name of the game right now. We are not in inflation. At some point we have to get to inflation. That's our way out of all these problems. We have to reinflate, and that's going to happen. So if that does happen, then gold benefits.
I talked this in the early part of the program about how Japan has been in a 20-year slump. I mean, that could happen here in the United States, and we could be in kind of that flat to deflationary play for a long time to come.
Well, it's being driven by in Japan. It's being driven by demographics too.
Right.
You have an aging population,
as we do here.
As we do here. I mean, the new millennials, the kids, just out of college, they can't afford a house, and a lot of them are living at home. They're putting off having kids. It's having an impact on the birth rate. Since post '07, with a tougher economy, the birth rates are down a bit. So there's definitely some issues. There's a fourth scenario, which is not a good scenario for the current currency war we're in, which Rickard talks about, and that's just complete chaos.
Yeah, let's hope that doesn't happen for a lot of reasons.
I know. It shouldn't happen. We're getting a better hold on our deficits, but now what we've seen in the last year is a real strong rise of the dollar. I mean, the dollar basically. I'm just pulling up a chart here because I want to be correct. I use UUP as my proxy on dollar because it pegs all currencies. Basically, it started moving up in beginning of July, yep. And it was at 21.25. And then we hit a high in March recently of 26.50. So yeah. we've had almost like a 20+% move.
Well, you're kind of in that fundamental issue of around the world. If you want safety in your currency, where do you go? You're not going to go to the euro right now. You're certainly not going to go to the yuan. They're slowing down. The almighty U.S. dollar still seems like the play.
Exactly. That's definitely a good way that it's playing out. I mean, the problem right now is, so the dollar's been really strong. It's had a pullback since March. It's come back to a really good level, 25, which is where it was kind of at January of last year after it got some strength. But if we look at FXF, we were talking about the franc earlier. The franc went from sub 96 to 115. And then by the middle of March, it had come all the way back down to like sub 97. And now it's at 105, and so those other currencies have been doing well. The euro got down to a low of, call it 102 and change in March.
Yeah, it's up to 111 now.
Now it's at 110, but yeah. I mean, if Greece becomes a bigger problem and the Europe descends into some type of chaos, we're going to break parity, i.e., we're going to break 100 on the euro. If we look at FXS, which is the Swedish krona, it's been crushed. It's gone from this year, about this time last year, it was 158 down to 112. Now, granted, Sweden gets a lot from the energy markets, and that's been a piece of why it's been hit. So we look at Canada, FXC. It's gone from like above 97 to 78, and now it's at 92. So what I'm trying to show is that around the world, most currencies are falling.
Yep. So, Jeff, I think it's fair to surmise this and kind of put it in a nutshell and say this. If you're going to trade in currencies, be aware that there's massive political risk.
You got overnight risk.
And if you're trying to do it to hedge inflation, maybe a better way to do it is just to use gold.
Use gold, or even, I'm a big fan. In my option services, I've done TLT, which is the 20-year Treasury.
Yep.
That's a great way to play it, because when you have deflation, that's a good thing for bonds, and when you have inflation, that's a bad thing for bonds.
Right.
So it's interesting how bonds peaked out, like TLT peaked out above 137, now it's at 122. So it's had a bit of a pullback, which would lead you to believe that we're going to get a pickup here. So this next quarter is very interesting, because the first quarter we basically had negative growth. We were down on stroke growth, and we had negative growth last year, and then we had a ripping second quarter in 2014, and we got the same potential in 2015. And in fact, Stanley Fischer, who's the vice chairman of the Fed, who used to be the head of the Israel central bank, mm-hmm. he basically postulated that we might be moving into an environment where the first quarter is just permanently weak. He called it the new normal.
To me, that's one of those things. I'm not sure there's not calendar. I don't know what I'd call it. I don't see the reality of a calendar giving us a different economic environment, but who knows?
The only logical explanation is you move to just-in-time inventory.
Yeah. So Christmas is less than it used to be type thing.
So much of retail is done in the fourth quarter of the year because of Christmas.
Yeah.
That you just, people want to see how it plays out before they start going to the factories and saying, okay, start ramping up for this next year. They may not just be doing it as much. I got a buddy of mine who very smart guy who I've known for a long time. He's been working on a paper on this and calling this the new normal. I mean, he's a dumb guy. He went to Harvard, Columbia MBA, worked for some of the best hedge funds in the world. I've known him for a long time, and he's right now he's kind of consulting with some of the biggest managers around, and he's been busy. But I'm like, you got to get that paper done because Fisher's talking about it. Everyone wants to know, is this the new normal?
Well, Jeff, I'll tell you what, we've let you run a lot longer this time than we normally do. And for all the money masters, you can see why I enjoy talking to Jeff. I learn something every time. He and I have had a 30-year relationship. It's been strong, and you can see that both of us share a desire to improve our lives and other people's. Make sure you check Jeff out at Superstock Investor or Quantitative Partners. He's a principal at both. And we'll look forward to seeing, Jeff, you on another program as soon as we possibly can. Thanks for being here.
Awesome. Thanks, Steve. Have a good rest of the week.
Well, it's always a pleasure to speak with Jeff, as well as all of our experts on this program. I haven't had Tim Newell on in a while. I think I should probably reach out to Tim, and certainly we'll get Doug Roberts back, and as I mentioned, Jason Wenk. But it's a pleasure to have Jeff come in and comment on how we can make money trading currencies. A lot of opportunity exists, and we're glad Jeff can show us the way. If you have questions about tonight's show, or questions about any of our shows for that matter, please write me at questions@safefinancial.org. And remember, you can always visit the archives of the show by going to safefinancial.org and clicking on the Safe Financial Network. You can see all of the programs as well as our Safe Insights and a number of my public interviews. So I welcome you to do that, and as always, to reach out with questions. Well, thanks for joining me tonight for tonight's show. It's always nice to see you, and I look forward to seeing you next week for another brand new edition of The Master of Money. But until then, have a happy, healthy, and prosperous week.